24 seconds away from the opening bow this morning. Good morning to you. We were looking for a bounce earlier on. We don't have that bounce right now. On the Nasdaq, we are just about positive by 0.05%. On a Russell, we're negative. On the S&P, up 0.25%. And yesterday was absolutely brutal. That's the opening bow. Switch at the board and get to the bond market. Yields just a little bit higher at the front end and through the curve, up 3 basis points. But even that move fades. 275.51. Euro dollar now down 0.9%. This is a 5th straight day of euro weakness. Euro dollar 105.41. Crude just about holding on to a 100 handle, 125. We are negative 1.4% and down about $1.50 so far. About 20 seconds into the session, let's break this one down for you. Information technology does bounce back a little bit, up 8 or 9%. The S&P, though, up a little more than 1/10. Let's call it 0.2% higher. With more, here's Katie Lyons.
Well, the lead in the technology sector today is Microsoft. That was the good news story from the tech reports we got after the bell yesterday. Beats on the top and bottom line. Thank you very much to the cloud. That was really the driving force behind 18% growth on revenue. The 19th straight quarter of double-digit sales growth for that company. But sales picture not so great for Alphabet. They're facing a lot of headwinds on the advertising front, including softness in the European market, weakness in YouTube with TikTok taking a bite out of that business, and also the Apple privacy rule changes that have dogged other advertising reliant companies like Meta's Facebook. It'll be interesting to see how that one shakes out after the bell today. Elsewhere, Texas Instruments also reported yesterday the chip maker had to cut its forecast due to China's COVID-0 policy, that creating some supply constraints for that company. And finally, just to check on Twitter as well, it will be reporting tomorrow, but no conference call, John, because Elon Musk is coming in to buy the company. What's interesting, $54.20 is the deal price, $49.08 is where we trade at the opening bell. So clearly investors still a little hesitant around some of the risks, including where is he going to get the financing and what do regulators think about that one, John?
$5 of doubt in the equity market right now. Katie Lyons, keeping an eye on that one. Thank you. So Alphabet and Microsoft behind us. Taylor Riggs, 3 big names still right in front of us.
John, it's countdown to the horse race. As you said, some of the big ones down, still 2 big days to go. We'll start with today, of course, Meta, Qualcomm as well. Certainly one that we're going to be watching when you think about the chip shortage and where we are with peak shortage behind us. And then, of course, a good read on the consumer. If you think about Apple and Amazon, further chips here, of course, with Intel. Kaylee sort of correctly said no one really cares now about Twitter, given that that story is old when you think about the quarterly results. When you think big picture of what to watch for, some decent numbers here, of course, expected on the top line. Bottom line maybe looks a little bit squishy, but I want to do a huge caveat here. Anurag Rana writing in, Apple is going to generate north of $90 billion in free cash flow this year. Amazon, from the cloud business alone, going to generate north of $20 billion in operating profit. So I want to be really careful when we think about sort of a declines here on the bottom line on a year-over-year basis when you just think about massive free cash flow these companies are generating. What it means is sort of big picture. You take a look at the Nasdaq 100 and the forward PE ratios here, and actually now relative to the S&P 500, some arguably might say it's starting to look cheap given the big declines here. You can see some big declines going back to about 2020 when you think of sort of valuations on a PE basis.
Taylor Riggs, thank you. What a tough month it's been for the Nasdaq 100. Tough year so far as well. Down by more than 20% or so. Down about 20% right now. Google, Alphabet down by 4 percentage points. KeyBank's Justin Patterson saying this. He adjusts his outlook. We're now lowering our earnings estimates to reflect elevated costs and ongoing investments. Justin Patterson joins us right now for more. Justin, your time is super valuable this time of the year, so thank you for giving it to us. Let's start there with the likes of Alphabet. You were a little bit cautious going into this anyway. Was what you expected in this number when it was released, these earnings, in the last 24 hours?
Yeah, I'd say it was largely consistent with expectations. Search a bit better than we forecasted, reflecting the durability of direct response advertising, product innovation, whereas YouTube was a big negative variance for our model. That was a function of a softer brand advertising environment, pullbacks from Europe, a difficult comp both from a year-over-year perspective and the Apple platform changes. Now there's this open-ended debate of whether TikTok is having an impact. So if I roll those factors together, throw in the FX weakness, where the euro is at currently, that's what gets to a revenue forecast that doesn't change that much, and earnings growth largely the same.
Justin, Ruth Porat has arguably transformed this company when it comes to buybacks. Ruth Porat delivered another one yesterday. Is that not making a difference here? Can you help me understand just capital returns and what it means for the stock?
Yeah, so there's two pieces in there. So if I look at just overall operating income growth, that was very healthy this past quarter, roughly 20%. Where you saw more of the variation was actually below the line at the interest and financial income level, where you just have various investments that are getting the negative mark, and thus you have EPS growth look a little more muted. The buyback helps insulate that over the course of the year. If you look at Google, it's nearly given all of free cash flow generation back to the buyback. So that's why I'm not too concerned about the stock here. There's just a very strong balance sheet, still very healthy free cash generation. As we work through some tough comps on 2022, a little more macro uncertainty, you start to get back to a more normal earnings growth profile next year.
Justin, I've got a few other names to whip through with you. It's just something that jumped out for me on the Bloomberg, just to see 54 analysts on Alphabet with 54 buys and 0 holds and 0 sells. Does that make you uncomfortable at all, just how big the consensus is around this single name at the moment?
Yeah, so I would say Google has been the most consensus long within the group so far. That just reflects the durability of the business, whereas you saw Meta, whereas you saw Snap face some incremental pressure from the platform changes by Apple. You really just haven't had as much of a headwind within Google's business. So more diversified, less platform pressure creates more durability toward the long-term free cash growth. In a market like this, where any softness does get sold, that could create a little bit of portfolio turnover here, but relative to others, I think you have the least negative revision cycle risk on Alphabet.
Well, it's been sold hard. It's down 17% month to date, so it's been pretty brutal. Any read across here for Meta later, Justin, for you? If we learned anything from Alphabet, what it could mean for them?
Yeah, I'd say combining these results plus Snap from last week, brand advertising a bit softer, so that's plus Europe. So that's one cautionary flag. And then as mentioned at the top of the hour, just the euro remains a headwind, I think roughly 105 this morning. So that's one more factor that's going to weigh on reported revenue growth, making FX neutral growth the key variable to watch.
You're perfectly positioned to help us answer the next question. The situation with Twitter, Justin, what are we learning about that situation? And does less censorship mean more difficulty with advertisers? And is that to the benefit of, say, Meta and Facebook?
Yeah, there's a couple of interesting questions in there. One, just Twitter has 85% brand revenue exposure, and consensus is around 25% ad growth for this quarter. If the better quality assets are growing roughly around 25% right now, fair to assume that Twitter is more exposed to the negative revisions going forward, which kind of reinforces why management felt the need to sell. On just, does this change the competitive landscape? TBD. Twitter is really a news platform more than anything else, so it has to go out, get the users engaged more first. It sounds like Elon Musk has some plans for that, and if it can do that in a brand safe manner, then perhaps the advertisers stick around. Right now, a lot more uncertainty, still a lot more content moderation that needs to be done. So I'd be cautious about just near-term pullbacks on spend on Twitter.
Justin, what did you think about the fact that we get the earnings this week, but we don't get the earnings call? Any reaction to that from you? Does that tell you something about what we might get, or am I just being a little bit too cynical?
A little more of the latter there. It's pretty standard practice that when a deal is taking place, companies do pull the conference call, so I wouldn't read too much into that. I will be curious to see if Twitter goes through its typical shareholder letter process or just keeps it as an investor brief.
What do I read into a 48 handle on the stock in early trading this morning? What does that tell you, that spread? 48 now, the offer price, the agreed price, 54.20.
It's very atypical to see that degree of spread for an all-cash offer, so there's certainly doubts, whether that's just regulation or a view that perhaps Elon may be overpaying here and rethinking the bid. Probably more regulation concerns, but we'll see what transpires over the next few weeks.
Justin, super busy. I know you've got a few more companies to cover through this earnings season. Justin Patterson there at KeyBank. Justin, thank you. Twitter down 1.8%, 48.80 in early trading. Coming up, a big week for US data.
It's going to come down to Friday's data. The employment cost index is going to be a very important data point for the Fed in terms of determining how much wage pressures are still in the system.
The employment cost index this Friday, whether you'd call that a big week or not, I don't know. Michael Purvis might of Tallbacken. He joins us next.
It's going to come down to Friday's data. The employment cost index is going to be a very important data point for the Fed in terms of determining how much wage pressures are still in the system. The ECI is the one that the Fed really hangs its hat on.
That's the data coming up this Friday. How do you take a portfolio from $1.5 billion to $35 billion? The Archegos founder Bill Hwang and CFO Patrick Halligan charged with fraud over a multi-billion-dollar mirage. Prosecutors saying both Hwang and Halligan, quote, repeatedly made materially false and misleading statements about the portfolio of securities to numerous leading global investment banks and brokerages. Following this for much of the last year, Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. We have a situation in which Bill Hwang and his former CFO of Archegos were arrested this morning, and they're expected expected to appear in Manhattan court later today. We expect a press conference a little later this morning as well from the Southern District of New York. And we have a situation in which a lot of detail in an almost 60-page unsealed indictment is revealed about just how big Archegos got, his communications here with his own employees and other banks, and also the sheer size of the positions he took. Think about it. How much he owned of Viacom, GSX, and Discovery. These are huge stocks that are traded every day in normal markets. So we do know the losses, of course, that the banks had gone through, but now we are also seeing the extent to which Archegos had gone. And remember, they are being accused of market manipulation and fraud. Racketeering appears as well in this indictment.
They're the allegations. Have we got an idea, Shonali, of the defense and how embarrassing this might be for some of the names of those banks on that board?
This is a great question here because we want to see what Bill Hwang will say next. Will he countersue in any fashion? Will the banks seek to reclaim any of their losses? Of course, there's kind of a tall order here in which the banks would try to reclaim some of those. We know there are other things going on in the background as well. The DOJ, the SEC, and other regulators keeping an eye on how this happened with the banks. Are there more regulations that need to be in place? And was there anything untoward that happened within the banks themselves? Remember, he amassed these positions on margin. He amassed them through swaps as well. So should there have been more clarity here? And also, should there have been more communications with regulators earlier on, John? That is still the looming question.
There are some allegations here, Shonali, that some people might look at and read and say, well, I thought that was just normal practice. You get to 5%, you find other ways of building up a stake so you don't have to disclose it. Do you think there's going to be some nervous fund managers around as well, Shonali?
Fund managers, yes, because there are some funds that were named here, but they were not named exactly. They're said there are funds in the background here. Remember, it's not just Archegos. There's a block trading investigation also going on in the background here in which both fund managers and prime brokerages are keeping an eye. And, you know, some of these stocks named, like Viacom, they involved huge block trades. One more thing, it's not just the fund managers being nervous here. Companies being frustrated with what happened here. If you're Viacom,
Sure.
if you're Discovery, and somebody amassed this much of your stock, where were the banks in letting you know what was going on? We did speak to some of the companies in which Archegos was an investor, and they did not get a lot of clarity at that time. So a lot of questions on how investors are able to amass positions this large.
Fascinating story, just absolutely fascinating, and really looking forward to your coverage that's going to take place, I imagine, not through the next few weeks, but perhaps through the next few years as well. Shonali Bassett, thank you. Wall Street correspondent on that story. Joining us now on this market, it has been tough over the last month, that's for sure. Tallbank's Michael Purvis joins us now. With the S&P bouncing back by 1%, the Nasdaq up by 1.46. Michael, you're keen to make the point to compare the S&P equal weight with the S&P 500 market cap weight. What does that tell you?
Well, the S&P equal weight is sort of a cyclical / value proxy in a way, right? Because it takes the big tech stocks down to the same positions as some, much smaller companies that are much more sort of economically sensitive and don't have the structural growth or the fantastic digital business models that some of these big tech companies have been have the benefit of there. So it's really just a very simple way of saying value and growth. But what I think is interesting is that if you measure the equity risk premium for the various indices, the NDX, the SPX, or the SPX equal weight, there's a very large dispersion of where those equity risk premium are there. And so I think, we always sort of focus on the S&P 500. That's where the conversation starts and stops. But in terms of this relative valuation to treasuries discussion, which is really what the equity risk premium encapsulates, it's those metrics are really very different compared to the historic norm. So the equal weight index has been a much easier buy than, say, certainly the NASDAQ.
So, Michael, some people will wonder not whether it's time to buy the NASDAQ. That's the obvious question. Whether it's time to buy the cyclicals, the banks. The energies have done great. Let's talk about the banks because they've done really poorly. I've gone through the year-to-date figures on JP Morgan. We're down 22% on JP. On Citi, we're down 16. On Bank of America, we're down 17. It's been really, really difficult, even with the Fed story, which most people would have argued coming into this year would be supportive of these names, Michael. That trade has not worked. Is there any reason to believe it will work at some point this year?
John, you look at Bank of America's valuation relative to the markets. It's at a pretty cheap level here. I don't understand the severity of the down move in banks. I've been buying the dip in large cap financials. The higher rate story should be very constructive. It seems to be that the recession is an inevitable narrative, and that's just coming around the corner somehow. But I still struggle with that. I'm not, I'm really not on that. Recession is an obvious base case in 2023, and so therefore I'm much more comfortable holding the banks. If we do get a recession, if that assumption ends up being wrong, I would expect it to be relatively minor and brief there. So I think, if you look, yes, there's some correlation with the 210 curves and so forth of the performance of big bank shares. There's some historical history, trading history there. But again, I think Jamie Dimon will tell you this, that higher rates across the curve are much more constructive there. If you just open a simple bank account and we look at the interest rate you get paid on that and turning around and buying 2-year treasuries with that, it's a nice little arbitrage for those banks to lock up.
I look forward to seeing how much my interest goes on my deposits over the next couple of months as the Fed moves 100 basis points. I imagine it won't be anywhere near that amount. Michael, just looking forward from here, you said that's not my obvious base case for 2023. Do you think an obvious base case actually exists for next year?
Well, that's a great question. I mean, I think this cycle, I think one thing about this cycle is that there's massive distortions within the cycle. And, I would argue that, the rates market have kind of jumped to late cycle, really a late cycle condition, even early in 2021. Equities, I'm arguing, are really kind of more mid-cycle there. And so you have these sort of odd sort of displacements right now. If you look at the projected earnings growth, not my earnings growth estimates, but bottoms-up consensus estimates compiled by Bloomberg, they are, of course, not growing the way they were in 2021. But they're not, the earnings trajectory is really not looking at all like a recession is sneaking around the corner, and the resilience of the earnings stream is really, really pretty remarkable here. So I keep coming back to the equity the equity gyrations we've seen year to date. Well, it's coming after an incredibly strong 2021 where you had a fantastic nearly 30% rally in the S&P 500 on top of a very strong 2020, right? And walking into a massive Fed pivot with a massive supply shock thanks to Ukraine sort of exacerbating everything else. Year to date, the market's down 12%, John. That's really not that severe. I think it's really a testament. I mean, people could say, yeah, okay, equities are being dumb. I'm sort of saying, well, maybe they're not so dumb. Maybe equities are that sort of a tell that there's a lot of inherent resilience when you're looking at nominal GDP. This year that could be well north of 8%. Very strong earnings for the larger companies that can manage their cost structures. There with the back end of the treasury curve that has been, of course, selling off aggressively. But if there's some stability that's found there in the next few months, I think you're going to start seeing a much more constructive path forwards for equities. But no question, the near term cross-asset volatilities are extremely high. The uncertainty factors will be high, and it's kind of a trader's market. I've been playing this market long and short, over the last 3 months.
Michael Purvis, a Tallback. And Michael, great to catch up, buddy. As always, I think most people would agree with Michael that we need rates vol to settle down. Some stability there would be super helpful for the overall market. This morning, we advanced on the S&P by a little more than 1%. Information technology bouncing back by 2.76%. A lot of earnings coming up. After the close, we'll hear from Meta. Tomorrow, Amazon and Apple. Your trading diaries next. Yesterday was absolutely brutal going into the close. 25 minutes out of the open this morning, and good morning, we are positive. There's a bounce. Will it stick? The S&P up more than 1%, the Nasdaq 100 up by 1.35 percentage points. That's the price action. Here's the trading diary. The U.S. Attorney's Office holding a press conference on the Archegos charges. That's at 11:30 Eastern Time. And it's back to big tech earnings with Meta reporting results after the closing bell. Apple, Amazon, Twitter, all coming up tomorrow. Plus, a Bank of Japan rate decision, another round of initial jobless claims in first quarter U.S. GDP, and finally, rounding out the week with a read on wages and consumption this coming Friday. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, April 27th. Here are the top market stories we are following for you at this hour. A tale of two titans. Microsoft beats thanks to the cloud, but Alphabet struggles with advertising headwinds. That sets the stage for Meta due after the bell. We'll have more on tech with Mark Lehman of JMP Securities. Archegos arrest. U.S. prosecutors charge Archegos Capital Management founder Bill Wang and CFO Patrick Halligan with fraud after the dramatic collapse of the family office. Federal agents arrested Wang earlier today. And flows halted. Russia cuts off gas supply to Poland and Bulgaria for refusing to pay in rubles. Four other European buyers have already paid in the currency, but Ursula von der Leyen says doing so violates sanctions. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's Wednesday, and I have a lot of questions about a lot of different things.
Yeah, I don't have any answers. I'm really confused about the gas story. I can't figure out exactly what is going on there. We're going to speak to Thierry Breton from the European Commission in the second hour of this program, the European Close. Maybe he'll be able to provide some clarity. The tech story, I think, is really fascinating, Kaylee, in terms of what we got yesterday, particularly looking at what is happening with Alphabet, coming through with, in many ways, disappointing numbers, but a big, big buyback program. And that clearly is not enough right now. And I think that's got implications for Apple as well. So I think there's, a lot of questions floating around, not a lot of answers. We're also expecting a press conference regarding that Archegos story in the second hour. Hopefully we'll bring you the kind of the most germane bits of that live just after the European Close. So all of that is coming up. We've also got some data coming out right now. Let me just bring that up on the screen to see exactly what's happening in the housing market. We have pending home sales dropping right now. A little weaker than anticipated, but the prior number actually down by -4.1, revised a little bit better. This number -1.2. The economists were expecting -1, and the non-seasonally adjusted year-on-year number -8.9%. So you're still getting a little bit of an effect coming through, I think, from the supply chain shortages that sector is experiencing. But actually, we're not going to focus on housing. We're going to focus on what is happening in the tech sector. As Kaylee says, some really interesting questions swirling around this sector, and we've yet to get all of the answers. Many reports still to come. But what are tech earnings telling us right now? Let's try and answer that question. Anurag Rana joining us, senior software analyst at Bloomberg Intelligence, and Jackie Davalos, Bloomberg technology reporter, who was doing some great work, I have to say, on the top lives yesterday as these numbers came out. Jackie, what was your biggest takeaway? What are we learning here from the tech sector stories we've seen thus far?
I think one of the big themes that came out of Alphabet's earnings, as well as Microsoft together, is that cloud demand is very resilient. I think there was a lot of concern about what would happen to cloud computing and its customer base if that demand will hold up in the face of returning in-person services and activities. And I think the results showed that there is still healthy demand for this, albeit a little bit less than the turbocharged growth that we saw during the pandemic, but it's still propped up both businesses.
Well, Anurag, to that point on the cloud, you were on with us yesterday previewing these results, and you essentially said the cloud is a recession-resistant business in many senses. Give us your take on what we saw yesterday on that front.
Yeah, a few things. First and foremost, these growth rates will slow down over time. It's just a function of large numbers. It's nothing more. Cloud is a very nascent market, or cloud infrastructure is a very nascent market where Google and Amazon and Microsoft largely operate. And there is a long, I would say, paths that we still have to cover for it to be mature. So, whether it grows 45% or 47 or 30, it really doesn't matter because the size is so big down the road. As far as other businesses, I think Microsoft really showed us that the critical part of the portfolio that they have, people will spend money irrespective of what the economic climate is.
What do investors want, though, Anurag? I'm looking, Microsoft's up 4, Alphabet's down 3% we're talking about here. What do you think separates those two businesses in terms of the way that investors are reading the numbers?
I'm a little more biased with technology companies. I didn't find anything that wrong with Google results. Frankly, from my side, I look at their numbers. They're still going to grow 15, 17% going into the next 2 years. Even if they grow 13, 14%, what's the big deal? Because in my view, I look at something like a Costco that grows at like 7, 8%, and it's trading at 40 times earnings. And people are, looking at Google and saying, oh, you're like 16, 17 times earning, and it's expensive, and we should, sell this. So it doesn't make sense to me, at least. But I'm more focused on tech companies. I think they are phenomenal businesses, far better than any other that's out there.
I have to say, I think when it comes to Google, one of the big highlights there was, this focus, investors homing in on its YouTube advertising business, and that, it's come out as a major player in search, and also the type of advertising that it has exposure to. I think we're going to start to see some of those divergences, especially as we have Meta report today.
Yeah.
YouTube ads were particularly disappointing, Kaylee. I think they were expecting much bigger growth. And what it showed is that, look, it was not the numbers that investors were expecting, but the bigger picture is that they are focusing more on short form videos, and TikTok is a major competitor there. So they're going to have to address that weakness for those numbers to come up.
Yeah, all the cool kids apparently are on TikTok. I myself am not, but it definitely is a big factor. So talk more about the read-through then to Meta after the bell today, and then Twitter as well tomorrow, or though there's an argument to be made there how much those results really matter when Elon Musk is going to take the company private anyway.
Absolutely. I think when it comes to companies that have digital advertising exposure, they are more exposed to those swings in e-commerce versus, a search ad business. And so looking into Meta today, I think we're going to want to see how are Reels doing. Now that we saw how important short form videos are to Google, investors are going to want to see progress versus Reel. How's that viewership comparing to TikTok? Google's short form videos right now have 30 billion views, which was a number that I think really surprised the street. And so kind of setting a baseline, Meta's going to have to show what progress they're making on that front as well.
Anurag, let's just talk about another metric on which these companies are judged, and that's buybacks. How important is it, the size of the buyback that you deliver? Because it's almost taken as a given now, I think, that the buybacks are going to be enormous. And I'm wondering whether actually investors kind of move past it fairly quickly. And I wonder if that's going to be a problem for Apple further down the road this week.
Now, in the short term, it could be an issue, but in our view, you look at these three companies you talked about. Apple's going to generate somewhere in the $90 to $100 billion in free cash flow this year. You look at Google, it's about 68 to 70 billion. Microsoft, north of 60 billion. What are they going to do with that cash? It's very difficult for them to buy companies, so they have to buy back a lot of their stock. And one of the things we mentioned yesterday was Apple over the last 5 years has reduced its share count by about 23%. Going forward, they're going to reduce their share count every year by 4 to 5%. That's a very, very big number for investors. So even if you have flat top line growth, you're going to get EPS growth of at least 5% just on that alone, let alone any kind of operating margin expansion or any other things. And that's a very big factor in our view.
Well, talking of big factors, is that alone enough to support these stocks individually that in and of themselves are massive factors for the equity market writ large? I'm just trying to understand what tech leadership or lack thereof is going to look like more broadly.
So once again, if you are a long-term holder, you'll be happy because the stock goes down, they're going to just buy more. So, from that point, it just doesn't make that much of a difference for a long-term investors, because one of the most important thing you want to think about for any of these companies is, can somebody threaten their business models? But if you look at the top three companies that I mentioned, I'm not counting Meta and Twitter in that, but the moat that these companies have along with Amazon, it's only grown tremendously over the last few years, and we see no barriers we see no competitor that can come out and take that away from them.
Jackie, just in terms of what we're going to be looking out for the rest of the week, what should we expect for Apple? What are we looking for here? What are the details that you're going to focus on?
I think the story here is going to be the impact of supply chain issues and those COVID-19 restrictions in China. You look at Microsoft, who was fairly resilient when it came to their PC business and those Xbox consoles. Those sales remained pretty strong, but there are more exposures to Apple when you think about our phones, our personal computers, iPads, all of that. If they want to keep, sales up and meeting consumer demand, I think we're going to have to, see what kind of impact this is having. And we thought we were the worst was over with COVID, but as these restrictions start to re-emerge, Apple might be one of the bigger ones, that tech giants that are hit from that.
And on the subject of Apple, Anurag, we actually just had a viewer writing into us on the IB chat. Remember, you can do that on your Bloomberg terminal. His question is, why not pay special dividends instead and really help stakeholders? Why can Apple not do that?
Well, yeah, they can do that. I see no logical reason they can't. I mean, it depends on, once again, you go back to Buffett's methodology. If the stock is selling below its intrinsic value, the company should be buying back as much stock as they can, or they financially, they're able to.
All right, on that note, we will leave it. Thank you so much to Anurag Rana of Bloomberg Intelligence, as well as Bloomberg's Jackie Davalos. Now coming up, we'll continue this conversation on tech earnings and their implications. BlackRock's head of thematic strategy for global allocation, Kate Moore, will be joining us next. This is Bloomberg.
Great questions. Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
It's a big week in big tech earnings. Yesterday, we got Microsoft and Google. Later, we'll have Meta and Qualcomm. So let's get back to our question of the day. To this point, what are tech earnings telling us? Let's ask our next guest, Kate Moore, head of thematic strategy for global allocation at BlackRock. Kate, are we even getting a clear signal yet?
There's not necessarily a clear signal for the entire sector and certainly not for the whole market. But what I will say is, and this is coming not just from tech earnings, but from commentary from companies across different industries, tech spending is much more resilient. You know, the previous two Bloomberg contributors who were just on that segment before me, mentioned this idea that sort of tech spending is recession-proof. And we're getting that information from different companies. No one wants to cut, and no one can afford to cut, frankly, their cyber software budgets. Most people do not want to reduce their spending or decelerate their move to the cloud. And some of these companies, particularly the higher multiple software companies, either playing in the cyberspace or playing in the kind of broad cloud adoption, had really derated over the number of, it's now about 6 months worth of derating. And they're starting to look very, very interesting, I have to say, from a medium-term prospect, especially if you think the economy is going to soften over the course of the next 4 to 6 quarters.
What assumption do you have to plug into that, though, Kate, for interest rates? Bridgewater thinks that the Fed's going to have to go significantly higher in order to contain inflation, well higher, well north of where the market expects it to go.
Yeah, so at BlackRock, we're very much in the camp that the Fed's going to move 50 basis points at this next meeting and likely follow a lot of the market pricing, perhaps another 250 basis point hikes after that. That said, I think we all know, students of monetary policy and students of economics know that monetary policy works with long and variable lags. And the Fed is not going to try and get too aggressive, particularly hike too aggressively into a softening economy. One of the big challenges that we talk about all the time, and I know you guys talk about on air all the time too, is that a lot of the inflationary pressure is frankly from the supply side. And sure, we can calm demand a little bit, but it doesn't change some of the supply disruptions we've had as a result of the pandemic or China's shutdowns, or it's not going to really change the mix in the very near term that's driven by, at the headline level, much higher energy prices as a result of Russia's invasion of Ukraine.
Well, Kate, to your point on inflationary challenges, supply side issues, all of that reads through right to corporate margins as well. Have you been surprised by what we have seen on that front thus far, 2 weeks into earnings season?
I've been really encouraged, Kaylee, I think is the way to think about it. Stepping back from this past quarter, just think about the last couple years. The naysayers and the skeptics have been saying for not just a couple quarters, but for years, that corporate margins were set to collapse, that it was going to be impossible for companies to maintain their costs in a revenue environment that looked more modest. And now we have a pretty robust revenue environment, but now we have so many additional cost pressures. I've been really encouraged because what we're seeing is a continuation of, frankly, a behavioral shift that began 10 years ago post-GFC of corporate management teams really focusing on their bottom line, controlling costs, upweighting businesses that have higher profitability and higher chance of maintaining margins, and really streamlining wherever they can in order to maintain their margin story. So I do think that margins are unlikely to expand in 2022. Stabilization or modest degradation seems like a giant win, but I'm certainly not in the camp of the margin collapse, run for the hills.
What is your view on volatility right now, Kate? We've got a situation where it's elevated, it's not that elevated. VIX is kind of circa 30 right now. Should investors wait for a lower volatility environment? Are we going to get a lower volatility environment? These markets seem pretty confused right now. We're being whipsawed on an almost daily basis.
Yeah, the markets are confused, and the uncertainty factor, guys, is some of the highest we've seen in the course of the last number of years. I would argue for most of us, in my 20-something year investing career, this is the most confusing it has been. And that uncertainty factor is, as we know, driven by a multitude of different forces. It's not just the path of policy rates and the path of inflation, the ending of the pandemic, hopefully. We have a conflict in Ukraine. We have spikes in energy prices, really weak consumer sentiment, which I think is driven more by politics than actual policy or the economy. There's just so many cross currents. And against that backdrop, it's really hard to see vol coming down dramatically. That said, in the fund that I work on, Global Allocation, we take advantage of higher vol environments and have been employing tons of option strategies across our book in order to really capitalize on this higher vol.
But on the subject of volatility, uncertainty, and asset allocation, we ask often, in this kind of environment when none of us seem to have a real clue what is going on, is this an environment you want to be in cash? Usually the answer is still no, but you actually think there's a role to play here for dry powder. Why?
Absolutely. So we are a multi-asset fund, and we can kind of go anywhere in the world. We're holding very high cash levels relative to our own history. Some of that cash is actually an expression of our duration view because we do think rates will move higher from here as the Fed adjusts policy rates as inflation is stickier. Some of it is also that we've de-risked parts of our equity book in response to this high uncertainty factor. By the way, when we've de-risked, we've raised cash a little bit on the equity side. That doesn't mean we've hidden off in defensives or in kind of lower quality companies. We still like a lot of high quality growth companies that can, we think, perform well once we get through this sort of sentiment bubble. But yeah, we're holding really high cash relative to history. I think it's an important asset class right now, and we want to have dry powder for the future, but we also want to protect the returns we've had thus far this year.
Kate, what kind of catalyst would you be looking for to deploy some of that dry powder?
Yeah, it's a great question. And I have to be honest, it's something I ask myself every day. What is the positive catalyst that could really get me to start taking a lot more risk? What I would say is a small positive catalyst, frankly, is the amount of negative sentiment in the equity market at this moment. We've seen institutional investors, certainly on the hedge fund side, also on the real money and retail investors, all become quite cautious around risk-taking. That can be a contrarian indicator, but that is not sufficient to take a lot more risk. I think we need confirmation that there is no real degradation in particularly the U.S. economic story. There's a lot of talk, as we know, about recession and recession risk coming sooner rather than later. If we get more high-frequency data that suggests that the U.S. economy is good through the course of 2022, I think that will be supportive, combined with very bearish positioning and sentiment. I think that could be supportive. But a big rip higher to, kind of flat for the year or to new all-time highs is not in my forecast for the next couple months.
Kate, it's always great to catch up. Thank you very much indeed. Kate Moore of BlackRock. Greatly appreciated. Okay, what do we got coming up for you? The latest fallout from the collapse of the Archegos Capital scandal. Founder Bill Hwang and his CFO have this morning been charged with fraud. Hwang has been arrested. Details next. This is Bloomberg.
About that all day yesterday.
It was a spectacular collapse of a family office, one that cost banks and investors billions of dollars. Now, federal authorities have charged Archegos Capital Management's Bill Hwang and his CFO, Patrick Halligan, with fraud. With us now is Bloomberg's Wall Street correspondent, Sonali Basak. She literally has the entire indictment guide printed out, and it looks like a small manuscript. Understand 11 criminal counts. Can you just walk us through what exactly these charges are, Sonali?
This is required reading for bank general counsels and lawyers across Wall Street. This is really outlining exactly what happened, how he amassed up to 50% of the outstanding float of some of these securities, things like GSX, Viacom. He had an enormous amount of what was daily traded. So how did the banks then not know? They said the banks were misled in some of the language that the SDNY laid out here. As we know, we'll hear more from a press conference a little later from the Southern District. But there's also some more detail here. Working with another hedge fund, for example, in some of the stock trading that happened in the background here. The way that the Archegos fund had traded stocks pre-market into the close and post-market in order to inflate some of the values of these stocks, and really how the entire scheme had come together. Now, the question that remains is how will Bill Hwang and his team respond, and what is left for the banks to say after they've already incurred these losses and regulators are already conducting their investigations on their own.
Absolutely. But Shonali, is this an opportunity for the banks, or is this a risk for the banks? There are lots of red flags around Bill Hwang already before we had this scandal blow up. And is there a danger that they end up looking even worse as a result of the details that are likely to flow from this investigation, from this prosecution?
Yeah, I think that's the big question. There's one meeting that people keep on talking about that happened in the wake of some of these price movements, and the banks had all gotten together and really had a conversation about what they do with these positions. The big question that remains is, should they have called the regulators in that event? Why did they try to handle this on their own? As we know, the banks sold the stocks on their own right, really got out of these positions early on. Some of them were able to mitigate losses, and some had much bigger losses. The banks are fighting among each other, as we know, with some of these moves that happened early on in Archegos. So what we do know, and you and I have talked about this, Guy, that regulators have already both been investigating. You have the DOJ, you have the SEC, and others really looking at what happened here and if there's anything wrong that the banks had done. But then also the fact that should there have been more regulation in place. Now we are waiting for a new Fed supervisory chair, and will they go back and say that the banks should have a better handle on how much leverage their clients are amassing, and can they amass these positions on swaps in such a large way?
Yep, lots of unanswered questions. Maybe we'll get some answers. You never know. Shonali, thank you very much indeed. Press conference coming up. We'll bring the details of that press conference to you live. This is Bloomberg.
We are an hour into the U.S. trading session, and equities are struggling for direction. The S&P 500 was clinging to a gain. Now it's essentially flat, and while the NASDAQ 100 was higher earlier, it's now down by about 0.25%. The market really trying to digest big tech results. I'll have more on that in just a second. In other asset classes, though, you do have a 10-year yield that is moving higher, so a little bit of selling pressure in the bond market. We're up about 4 basis points. 275 or so is where we trade. What's really interesting is the dollar. The DXY out at a 103 handle. That is the strongest U.S. dollar going all the way back 5 years. And of course, a large part of that actually has to do with euro weakness today. And that relates right back to a gas story that, Guy, I don't think either of us really can figure out. First, you had Russia cutting off flows to Poland, Bulgaria because they refused to pay in rubles. Then we got news that some companies are paying in rubles. Then Ursula von der Leyen comes in and says doing so actually violates sanctions. A lot of question marks for Europe more broadly, but especially the natural gas market. Dutch front month futures up about 18% over the last 2 days. To come back, though, to that earnings story I mentioned, of course, you have some big decliners off of the back of earnings. Boeing is one of them. Worst decline for this stock potentially since 2020, down about 12% after misses across the board and a way larger cash burn than analysts anticipated. And then a mixed story when it comes to those tech titans. Microsoft benefiting from strong growth in the cloud. It's up more than 4%, while Alphabet is down more than 4% due to advertising headwinds. The question now, Guy, how does what we saw with Google and YouTube especially read through to other advertising-reliant companies like Meta? It reports after the bell today. It's down about 3% ahead of that, Guy.
And how does the really strong performance in the cloud of Microsoft relate to Amazon? AWS potentially is going to have a good story off this to tell. We'll see. Obviously, as we work our way through this week, we're working towards Amazon. Sorry, not Amazon. Apple a little later on this week as well. Busy week. Lots of things to get through. A lot of them seem to begin with A. Okay, more on tech earnings now. Mark Lehman, JMP Securities CEO, joining us now. It's a Citizens company. It specializes in investing in tech. Perfect man to talk to. Mark, what do you make of the situation thus far? What did we learn last night?
Well, we learned that there's not a lot of clarity, and I think we had expected more clarity when we got some of the tech titans to report. And Microsoft obviously continues their ascent, and the advertising market and the competition, like Netflix has shown us, and now YouTube has shown us in that space, is heightened. And that when you have heightened competition, margins start to go down, and that's what we're seeing for some of those names.
So for the ones that have yet to report, what would you anticipate? Let's just start with what's reporting today, Mark. Meta, what's your expectation?
I mean, Meta has already had the tough fourth quarter that we saw reported earlier this year. I think expectations are a lot lower. That stock continues to make new lows, new 52-week lows. I think any inkling that some of the bleeding has stopped for them, and the stock should react more positively. But competition is not slowing down. TikTok usage continues to accelerate, and some of the things that are happening to Facebook on all their sides, their expense bloat, continues. I think the slightest whiff that they have this under control, the stock will do better because it has had such a huge decline this year. But that's what I expect today, and we'll see those numbers. If they have any clarity that the declines have slowed, I think the stock does better.
Mark, why do I want to own any of these stocks? Is it because they're growth stocks? Are they still growth stocks? Or are they basically buyback stocks? They are juggernauts in terms of the amount of cash that they are producing, certainly the big ones like Microsoft and Alphabet, and they're buying back stock and they're buying it back aggressively. What is the central case for wanting to get involved here and put money to work here?
Well, it's a great question. I think when we went into 2020 and 21, we kept talking acronyms. We talked about the FANG stocks, and we talked about, I called it Mount FANG because I added Microsoft and Tesla. And you just wanted to buy all those stocks. And now we're learning that they're not one big monolith, that you look at a Microsoft reporting versus what we saw when Netflix reported, and they're wildly different stocks. So that's the first thing. The second thing is they're getting to reasonable valuations. You look at where Alphabet's trading today, and you look at the kind of EPS power that they have while they're making some investments, and the earnings power is still substantial, and they're going to have a 5% free cash flow yield next year. 5% for a company that's growing that fast is pretty attractive. Right now, nothing's attractive. And I think it's very easy to sell and say, I'll get in later. Well, we all know getting in later is hard to do because there's always a time. No one, the light switch doesn't dim when things are bad. It crashes to off, and you got to figure out when to get back in. And I think that's what investors have to figure out. A company like Alphabet with a 5% potential free cash flow yield next year is wildly attractive. Maybe not today, maybe not tomorrow, but eventually.
But what are you assuming rates are going to look like with your assumption then that Apple's going to look that attractive? I mean, what level are we talking on the 10-year mark? On real yields especially.
That's the real, and I think that's a good question. I think there are some signs that some of the pressures on inflation have abated, right? We saw used car pricing last week. We saw the consumers definitely trading things that they can do with their money as opposed to doing everything, right? They're doing experiences. We see travel picking up. We see some other things that are slowing down. And I think that inflationary pressure, when we see that it starts to abate in some of the numbers going into the fall, I think you're going to probably see the 10-year settle in about where it is today, if not slightly lower. And that'll be a great backdrop for companies like Alphabet if you'd like that free 5% free cash flow yield. But there's right now, boy, when earlier in the show you said the VIX is kind of settling in there at 30. As a person who's been on Wall Street for 30 years, that don't sound like settling in there. That sounds like more volatility is in front of us, and nobody cares.
How low? What would be an entry point for you on Alphabet?
Well, I think today's an interesting example. You got a stock that's down a great deal from its all-time high. Although let's not use that as a moniker because we have lots of stocks that are down a lot from their all-time high, and that doesn't mean you want to buy them. But a company like Alphabet that is gaining market share, that has platforms that are growing rapidly, that's in every growth sector of what is going on in our economy today and going forward, you can own one of the great platforms at a 25 or 30% off sale. That's a good entry point. I wouldn't tell you that today is the day that you got to put all your capital to work, but I think over time, if you got into the stock over the next 6 to 12 months, as they continue to heighten their market share, and it gets more and more attractive as we're looking more and more at 2023 earnings as opposed to 2022, you'll want to be a participant in that stock. It's very hard on days like today and weeks like this week to feel a lot of conviction. That's why the VIX is at 30. But over time, I think that's where you want to be.
All right, on the subject of market share, obviously the dominant market share player in the cloud at this point is still AWS. It's still Amazon. Can you just walk us through your thesis around that business and that company in particular?
I mean, Amazon is like you said, is everybody knows and everybody uses it every day. So they understand what the consumer business looks like. But I think they're high growth businesses, like Microsoft's high growth businesses in the cloud. And I think that share and that move has not even close to being a mature business. And I think that's another stock. Amazon's had a tough year like a lot of the consumer-facing stocks, but their share in the cloud is growing. And their margins in that space are growing. And I think there's a lot of digestion in some of these big growth tech growth stocks like Amazon. And you saw what Microsoft did. Despite fears of a slowdown, what they did in the cloud was so substantial this quarter that has the stock higher today. Another example of a company where I think you're going to look at a year from now and say, I had an opportunity to get into the stock at a more attractive valuation at a time when there was lots of things to worry about. And there's worries about the consumer. They're worried about some of the growth businesses Amazon has, but the cloud business is not one I worry about.
How do you think about Apple? As we look towards the numbers later this week, what is Apple? And that leads me on to kind of what should we look for in the numbers. This is a company that is increasingly migrating away from being a hardware company, but it is still predominantly a hardware company. Is the market getting to the point now where it can understand the services business? And how do I fold, for instance, what has just happened with Netflix into that narrative as well? I'm just trying to think about how you value Apple as a services business and how that is different to Apple as a hardware business.
Well, it's a great question, and I think that answer we'll know in a bit. But I think you phrase it properly. Continually, the numbers are migrating to more of a service multiple and more of a service company. It's ubiquitous, right? I mean, you looked at some of these pronouncements over the last quarter. I read one with kind of a little bit of a smile when they said that getting a green text is not viewed on college campuses and around the world as a good thing. We want blue text, meaning we want Apple text, which I think tells you about the power of that company. They're also pretty quiet, which I think is really interesting. Tim Cook is one of the quietest CEOs, and I don't mean that he's not powerful. I mean, when you look at people like Elon Musk and some of the other people who are on the cover of all the newspapers and all the shows every day, we haven't seen Tim Cook a lot. Yet you look at the power of what he's done in the last year, about what he's done, frankly, to some of the market caps of some of the big tech giants, and you realize how powerful that company is. And they've quietly gotten more and more into a services company. They've quietly disrupted more of technology than everybody else.
Yeah.
So whether we're talking about payments or mobile or auto or entertainment or all the things that they have, healthcare, it's growing rapidly right underneath the veil of all these loud CEOs who are telling you how great they are. Tim Cook just executes. And I think that's,
and Mark,
a fascinating point. Yes, please.
That execution has also gotten Apple a very, very nice pile of cash. And we were speaking with our Bloomberg intelligence analyst, Anurag Rana, about this earlier. You have all of this cash. These companies, because of regulatory risk, can't really use that to buy other companies. So where else are you going to put it other than buybacks? Is that the best use of cash? And do you expect that to be really the only place that these companies can start to channel some of the money that they're generating?
Well, that's a great point, and I'd push back on one point, which is the specter of regulation has been far more worrisome for these companies than actual regulation. And the specter of congressional oversight has been far worse than the actual oversight by Congress. We saw Mark Zuckerberg put his suit on, which he does once a year to talk to Congress and defend himself, and we haven't seen him put a suit on in a while. He hasn't been in front of Congress in a long time. They're busy with COVID and the war and the election. They're not busy with oversight of these companies. Microsoft's made some acquisitions, as you know, in gaming and cyber and some other areas. I would not expect the acquisition binge to slow down. They may be smaller, although Activision was quite a big acquisition. They may be smaller, but I don't expect these acquisitions to slow down. I think they have a real playbook about where they see these multi-trillion-dollar markets, again, whether it's healthcare or automotive or entertainment or cyber or all these places, and they have their playbook, and they're going to keep going until they're told to stop. And I don't see them being told to stop.
All right, on that note, we will leave it. Mark Lehman, CEO at JMP Securities, a Citizens company. Thank you so very much for joining us. Now, as we were having that conversation with Mark, we have to as well pay attention to the evolving situation when it comes to Russian fossil fuels. We had a headline crossing from Germany. They say they are ready to support an EU ban on Russian oil if it is gradual. So again, this is oil. This is not gas, which is really the question for Europe at the moment after we saw the cutoff of gas flows to Poland and Bulgaria. But again, Germany ready to support a ban on Russian oil if it is gradual. I think the timing here is probably going to be key in this one. Guy, of course, we had JP Morgan making that call last week, $185 oil if you were to see Europe just cut it off, cold stop immediately. Gradual, though, it's a bit of a different story because you have room to get that oil to other places in the market like India and China.
Yeah, oil is a little bit more fungible, a little bit more transportable than gas is. The gas pipelines go in one direction, and that's towards Europe largely. So that's a much more difficult narrative. Germany can sort of uses around 40%, gets 40% of its gas from Russia. The oil story, I just wonder whether this is a bit of distraction coming through here. I appreciate that the oil usage story is a significant one, but the issue is gas.
Yeah.
That's where the focus of attention is right now. And the rules for European companies, I don't understand them. You and I have joked throughout this entire program. There is this two-step process. You can transfer money to Russia in euros. Those euros are then converted into rubles. That keeps the Kremlin happy and largely seems to circumnavigate the sanctions rules. But von der Leyen's indicating that's not the case. And if von der Leyen's indicating that's not the case, then in theory, Germany should stop using Russian gas.
Right.
It can't pay for it. I don't know where we are on this. I think we really need some clarity, and we need some clarity soon, because Germany is going to potentially be facing a significant recession if that is cut off.
Yeah, we will continue to look for clarity and try to get answers to our questions. Meantime, Guy, Boeing executives are answering questions right now as the earnings call is underway after that really brutal report. Shares down more than 11% as a result. We'll have those details next. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. The European Union calls it blackmail. Gas prices on the continent surged more than 20% after Russia stopped natural gas flows to Poland and Bulgaria. Moscow made good on a threat to cut off buyers if they didn't pay in rubles. Bloomberg's learned that some European companies have already paid rubles for gas. SpaceX has launched 4 astronauts to the International Space Station. It's the first NASA crew equally made up of men and women. It includes the first black woman making a long-term space flight, Jessica Watkins. They'll arrive at the space station 16 hours after launch. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Kaylee.
Angel, thank you. Meanwhile, shares of Boeing are lower, substantially lower. The stock off about 11% at this point. It ran into first quarter headwinds from inflation, the war in Ukraine, and the lingering effects of those 737 MAX crashes. The analyst call is underway right now, and with us is Brooke Sutherland of Bloomberg Opinion. She has been following the call. She is also with us. Brooke, this is really quite ugly.
It is, and I think what's striking about it is that this is far from the first ugly quarter that we've seen out of Boeing. I mean, it's now been 3 years since the second 737 MAX crash, and obviously the effects of the pandemic were significant on Boeing, but we're still just getting these self-inflicted wounds, if you want to call it that. I mean, you know, about $1 billion in charges announced today in the defense side of the business, having to do with some of these fixed cost programs. Their strategy there a few years ago was to bid low on the expectation that their commercial aerospace program would give them more cover to be competitive. And obviously it has not played out as expected. But the fact that we're still getting these kinds of updates, I think is just very difficult for investors to wrap your mind around what is the strategy, where is the exit ramp, how do we get back to a point where Boeing is, you know, an investable stock again.
DC Dave Calhoun joined 2020. It's not been good since then, Brooke. How long has he got?
Yes, I mean, with Calhoun, I think obviously it has not been a success. I think it would be a stretch to call it that. I mean, I have a hard time pointing all of the blame toward him just because I think he obviously inherited a very difficult situation. I mean, a lot of what we're talking about are sort of consequences from bad decisions that Boeing made a very long time ago. And, you know, the thing with aerospace programs is that these consequences take a while to catch up with the companies that are involved. And I think, you know, what's difficult is I don't know if anybody could have navigated Boeing through these troubled waters over the past couple of years, but I just think it's very difficult to look at these continued delays on their aerospace programs, some of which are out of their control, some of which are not, and to see, you know, again, where do we get back to a point where Boeing is consistently generating strong cash flow?
So how are Calhoun and the other executives defending themselves on the call? You were listening to it. What are some of the key takeaways from that?
You know, they're still positive on being cash flow positive this year. I mean, I think that's difficult to see how you get there. You do have to hope that maybe some of these 737 MAX deliveries might start picking up again. Right now, that is complicated by the fact that they're not delivering them to China. There was, of course, that crash on an older 737 model, which sort of complicated the picture there for Boeing. And then also, perhaps more significantly, you have the lockdowns in China that are limiting demand for air travel. So if you're an airline in China right now, why do you want more airplanes? And so, you know, again, a lot of this is out of their control, but that's not a great sales pitch right now. And look, certainly they're not the only company dealing with inflation, the effects of the war in Ukraine, supply chain constraints. We heard yesterday from GE, 3M, Raytheon. They are all dealing with these issues too. I think what's different in the case of Boeing is that it has so many idiosyncratic problems. So if you're looking for a place right now to invest, to bet on the industrial economy, it's tough. And aerospace, ironically, should be one of the bright spots. I mean, we've heard from all the airlines that business travel is starting to come back. International demand is picking up. People are getting back out there. Airlines want to buy new planes, but Boeing just can't get out of its own way.
They make the F-15, the F-18, they make the Osprey, they make the Apache, they make the Chinook. Brooke, there's a big war happening. How is a company with a major defense footprint not in a better position right now?
Well, I think one of the things that's interesting is that, you know, we did see this big rally in defense stocks on the war in Ukraine, but it does take some time for those dollars, that spending that we've been talking about coming out of greater defense budgets in Europe to hit those companies' income statements. So that is a later story, probably more like 2023, 2024, where we really start to see the impact of that spending for these companies. And in the case of Boeing, I just come back to, you know, they underbid on some of these programs to be competitive, to make sure that they won them, and then now they're paying the cost for that because these are fixed cost programs. When you have inflation, when you have supply chain constraints, that makes that calculus tougher.
A lot tougher. Brooke, great stuff. Thank you very much indeed, as ever, for the analysis. Brooke Sutherland of Bloomberg Opinion. Greatly appreciated. This is Bloomberg. About 34 minutes to the European close. Let's talk about the price action on this side of the Atlantic. European stocks bid. That's not where the story is. The story's in euro dollar. Look at this. 105.22. We're about to break 105 by the looks of things. That's certainly the direction of travel. We're down by around 1%. And it comes down to this problem here. The Nat gas story. We've seen the start of Russia beginning to cut off Europe from gas supplies. There's confusion as to how you can pay for gas supplies. Apparently, if you pay in rubles, you're in breach of sanctions. Apparently, that leaves 4 countries, potentially 10 companies in breach of sanctions. Does the two-step process where you pay in euros or dollars and they get converted into rubles, is that acceptable? Well, we're going to hopefully find out in the next hour. We're going to be speaking to the EU's Internal Market Commissioner, Thierry Breton. He's going to be joining us from Brussels. It's an exclusive interview coming up. We need some clarity on this. Von der Leyen saying basically you're in breach of sanctions if you're paying Russia. Is that actually the reality of the situation? And if so, how big a problem is that for Germany? The close is next. This is Bloomberg. Wednesday the 27th. In aggregate, European stocks are higher. Miners are doing the heavy lifting, but the story's actually in energy and the collapse of the euro and the pound. Lots to talk about. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
30 minutes to the close. This is what the price action looks like here in Europe. Stocks are higher. However, take away the mining sector and that number looks a lot uglier. It's the only sector that's doing the heavy lifting right now. The story elsewhere looks really tough. There's only a few sectors in positive territory. Mining by far and away the outperformance today. The story is elsewhere, I think, actually outside stocks. It's in the currency markets, it's in the energy markets. Euro dollar breaking lower today, as is the pound. Keep an eye on what's happening with sterling as well. We've got a 105 handle. We've nearly got a 104 handle. How far away is parity? I'm being told keep an eye on the 103 area. Quite a big air pocket, a lack of positioning below that. We're down by just over 1% today, 1.1%. The story, though, really stemming from the problems that Europe could generate if we see a cutting off of Russian gas. We've got the Dutch front-month contract up by around 5% today. It's interesting, actually, UK gas. UK's got loads of gas right now, a little bit lower. Over 2 days, that number looks a lot uglier. The concern, of course, is that the situation we've seen thus far with certain countries being cut off could be expanded. Thierry Breton is going to be joining us very shortly, the Internal Markets Commissioner. We'll try and get some clarity from him on exactly what the rules, Kayleigh, ultimately look like here.
Yeah, so we're looking for answers on that, and this equity market here in the United States, guys, looking for answers as to how exactly it should read the big tech results we have already gotten and those to come. We've really seen a lot of fluctuation in the markets today. The NASDAQ 100 was higher, then it was lower. Now, once again, it's higher, right around 0.9% higher, in fact. So you're starting to see some of that optimism coming back. Largely doing that heavy lifting is Microsoft. It's up more than 6% after beats on the top and bottom line. Thank you very much to the cloud. Different story, though, for Alphabet. Advertising headwinds creating a sales miss for that company. It's down about 3% as a result, taking the communication sector down with it. That is your big underperformer on a sector basis within the S&P 500 today. Other than the earnings story, the story we continue to monitor, and this is directly related to what you were just discussing with the euro and the pound guy, is the strength of the U.S. dollar. The dollar DXY, dollar spot index, at a 103 handle. That is a 5-year high. Really interesting to see these dynamics playing out on both sides of the Atlantic guy.
Absolutely. Let's focus back in on what is happening with the energy story, though. Certainly here in Europe, a challenge. Germany apparently changing course on a boycott of Russian oil. Bloomberg has learned this afternoon that Germany is prepared to back a gradual ban, gradual being the most important word in that sentence. That's happening as a major escalation over Russian natural gas supplies is continuing to unfold. Moscow cutting off flow to Poland and to Bulgaria. European gas prices spiking as a result of that. But we also have a lack of clarity on what the rules are here. What can you pay with? Can you pay in euros and dollars? And what happens if those dollars and euros are converted into rubles? Ursula von der Leyen saying, in theory, that would break sanctions. Rachel Morrison, Bloomberg's energy reporter, joining us now to give us some clarity. Can you please give me some clarity? Because we're really struggling to understand what is happening here. Bloomberg has learned that 10 companies have set up accounts that would allow them to make this two-step process. 4 countries are making payments using this 4-step process. Yet Ursula von der Leyen, speaking a little bit earlier in Brussels, indicating that in theory would break sanctions. What is going on?
Even this afternoon, things are getting more complicated, but it's also getting more interesting as we see the European Union not wanting to walk back from that position of what will and won't violate sanctions. But we're seeing companies trying to find workarounds to that. So what we're talking about here is when the contract is paid. Is it paid when you've paid euros, which the European Union says must happen, or when Gazprombank receives the rubles? So that's what is being figured out here. And we have companies with their lawyers saying they're studying how to find workarounds to this to enable them to continue with the contracts.
Quickly, Rachel, obviously we've already seen flows cut off to Poland and Bulgaria. Are we expecting in the near term any more cutoffs, or when's the next deadline?
We don't know any of the exact deadlines. We know that they all fall before the end of May, and those will all happen at different times. And so we're going to see it crunch time happen. Different countries do have different stances on this. So Poland and Bulgaria both said they wouldn't allow the ruble payments to happen. Other countries, the big important ones in terms of gas imports, Germany, Italy, seem to be more committed to finding a way. So initially we saw gas prices rise very sharply, thinking there could be more cuts. But as the day's gone on, the market has become more chilled, as we've been calling it.
Quite literally, probably.
Towards that.
Yeah. Well, summer's coming, so hopefully not chilled just yet, but the potential for that to happen next winter certainly seems to be growing. Rachel, great stuff. Thank you very much indeed. We'll continue to keep everybody updated as to what is happening here. As I say, Thierry Breton coming up from the European Commission very, very shortly. Coming up now is the chief executive of one of the biggest asset managers in the world. Stephen Bird, Aberdeen's CEO. The company manages $681 billion in assets. Good afternoon.
Good afternoon, Guy. Great to be here.
You are a long-term investor in a market that is incredibly volatile right now. We've just been talking about what's happening with gas. You've got the euro under significant pressure. You've seen significant volatility in tech stocks overnight. What do you make of the landscape in front of you right now?
Well, I think the most important thing is to keep perspective on what's happened. We've kind of very quickly lost sight of the fact that we had the largest recession since the Second World War during COVID, then unprecedented stimulus, in some cases some overstimulus. Now we're seeing central banks being behind that curve to try and tamp down the inflation which is running ahead. Now what's very interesting right now is that the situation is different whether you're living in the States or living in Europe or indeed the UK, and it's very different if you're in China. So as a global investor, what we are always looking to do is to interpret the differences between the circumstances of these decisions being made. Now the US, there is this tendency in the world, the US has got the lead on this whole situation against inflation, and the Fed's going to go hard. I mean, we've seen the fastest.
How hard?
Well, we've already said we've got 2 months from the ending QE, we're doing QT, and we're going to see at least 50 basis points increase in May, and then another 50 after that. Our central scenario is that that's what's going to happen, followed by 25 bips with a pause. Right. Now, we think the Fed's going to take it to 1 percentage point above neutral because it's going to have to feel tighter, otherwise it's not going to work. Now, the risk is that you get Fed emulation in areas where it's not the same situation, it's not the same problem. Europe's not the same problem because the closer you are to the conflict and the more dependent you are upon energy coming from Russia, you are going to have less impact by increasing rates on the price of energy. So you have to interpret that differently. Thankfully, that's what Christine Lagarde is clearly doing.
Stephen, yep, sorry, Guy, go ahead.
No, jump in.
Well, just on the point of central banks, and this is obviously Kaylee in New York. Stephen, great to talk to you. How do you view the balance of inflationary pressures versus growth pressures? And when we get to the point where inflation is demand destruction, therefore it actually is also a growth problem, just how are you viewing those two dynamics?
Well, I think I would tie it back to if the other central banks, the Bank of England, the ECB, if they actually interpret their context rather than emulate the Fed, then we've got more chance of the cycle, i.e. we're seeing a material slowdown in global growth, but we've got less chance of the cycle being killed by an overreaction, because we do believe you're going to have to see that discrimination between rates. Interestingly, in the currency markets, we're already seeing quite a bit of FX volatility showing up. And that's because I think the market's beginning to recognize there's going to be a differential rate response to what is now being interpreted as differential inflation pressures. We actually think that's a good thing, because by applying the right policy response within the context of your own region or country, you're more likely to be able to get a soft landing to this. This is clearly a very difficult needle to thread. I mean, you could almost couldn't make up, coming out of a global pandemic, very fast on the heels of what was a pandemic, then stimulus, then a conflict. Right. And as a consequence, that's why there's a lot of anxiety and a lot of stress. This is a precarious global situation, and it's going to require incredibly careful navigation.
How do you invest in this environment, though? There's a lot of things that are uncertain. Uncertainty by sort of definition, is very difficult to kind of quantify. Risk you can quantify, uncertainty you can't. How are you guys manage it? How are you personally kind of thinking about all of these risks and uncertainties and how you're going to invest through them for the long term?
Well, it's precisely that, Guy. We're looking for what is going to happen in the long term and what is the right home for your capital to get to that long term. So equities have traded off, fixed income has traded off.
Yep.
Now we're seeing, and that's the natural response to everybody anticipating a much higher risk-free rate. Bonds are beginning to look attractive. 2 years ago, the 10-year was 50 bips. Now it's approaching 3%. As you anticipate those sort of increases in yields, you can see that it now looks like they're investable again. They're a diversification option in portfolios. We invest on a quality basis, strong balance sheets, strong cash flows, defensible business models that can see through these events. Now, interestingly, China is last year regulatory reform plus lockdowns. We're seeing extended lockdowns in China now.
Yep.
But I think we also have to look past that. Do we believe that COVID's going to be here forever? Well, here we are in the UK. We're back in the studio.
Yep.
The Western world has been able to vaccinate and manage and get back into an operating environment. COVID's not going to be in China forever. So you've got to see past that to those business models and those mega trends that are still going to prevail in the 21st century beyond COVID, beyond the energy crisis, and beyond the current conflict in Ukraine.
Are public markets the place to do that, or are private markets the place to do that?
Absolutely, you have to be investing significantly in private markets, and we are doing that. We're one of the largest real estate investors in Europe. We're also an investor in Amazon warehouses, both here in the UK and in Europe with Tritax. We're investing in and seeking to always find what is the 21st century trend that will thrive, and then put long-term capital there. Electrification is clearly one of those that we're very actively involved in. We're very actively investing in the net zero economy. And we're at City Week. City Week's going on in London right now, and that's one of the huge themes. How do you envisage and invest in what will be a net zero economy? And Kayleigh, this energy crisis, if there's any silver lining out of such a horrible thing as this conflict, this humanitarian, terrible conflict taking place in Ukraine, is that there's a realization that you have to be able to have a path to energy independence. And I think that has been sharply brought to the attention of governments, perhaps too late. This should have been something that was planned for in advance of the conflict.
Well, and to that point, Stephen, we now have seen governments scrambling to find energy resources. President Biden, who came into office trying to be a climate president, tapping the Strategic Petroleum Reserve and asking oil players to pump more. Do you see the war in Ukraine having set the transition back or accelerated it?
I think in the medium term it will have accelerated it. There's going to be very expedient short-term things that are essential in terms of use of carbon in order to backfill the space that is lost from Russian supply. We're seeing this. We see the UK opening up a mine for the first time.
Right.
That type of activity, you're going to see that. You're also going to see, and it's longer term, but it's a very important change in terms of disposition towards nuclear, because nuclear and the new mini reactors are clearly also going to be part of getting to a net zero economy in the more medium to long term. I think that the lessons of this conflict will certainly have accelerated the path to net zero.
As you say, it is City Week. The City of London trying to figure out what its role in the world is going to be going forward. Brexit obviously is going to be a slow burn in terms of the impact that it's likely to have. Give us a sit rep. Give us a sort of sense of where you see things now in terms of where the city is going to need to evolve to next.
Well, the city is really, really important. First thing for the United Kingdom, when we're facing all of these uncertainties, having an industry, financial services industry, and professional services around it that employs 2.3 million people that generates 200 billion of economic value annually, and that produces 100 billion, pays 100 billion in tax. That's really important. So we recognize that it's an important industry. It's incredibly important for the long term in being able to allocate capital into the kind of economy that can thrive in the 21st century. And that's really what the whole agenda is about. How are we using technology to provide better services to our clients? Initially what happened was technology resulted in speed and convenience for clients. So you had online services, you had apps. But what's now happening is technology, through the use of data, through artificial intelligence, is impinging upon making better decisions for clients. So you really get the outcome that you need. And that's the race that we are all in now, using the data to get better outcomes for clients. And I'm very optimistic that we can do that. And when you see what's going on in the UK, the facts are quite stark. 1 in 10 don't have any household savings. 20% of fellow Brits don't have a pension plan. So this thing about personal resilience, long-term planning, understanding a true financial needs analysis for the population, and coming up with solutions and thinking new thoughts about how you can run your economy in a different way is really, really important. And that's what's happening with my friends and colleagues coming together, the banks, the insurers, the asset managers, as part of City Week.
All right. Well, it was great for you to join us after City Week. Thank you so much to Stephen Bird of Aberdeen. Really appreciate your time. He, of course, is the CEO there. Now, coming up, the European Union calls it blackmail. Russia is shutting off natural gas flows to Poland and Bulgaria. What do the rest of the people do? Is it going to be a sanctions violation if you do so? We'll try to get answers to these questions that we have in an exclusive interview with the EU's Internal Market Commissioner, Thierry Breton. This is Bloomberg.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
We're counting you down to the European close. In a few minutes' time, Kayleigh, we're going to be talking to Thierry Breton. He is the European Internal Markets Commissioner. We've got a really difficult situation developing. We've got a gas problem that ultimately could cause a significant recession in Europe. The euro's trading 105. You've got the pound under a little bit of pressure as well, but the dollar just keeps going from strength to strength.
It absolutely does. The dollar spot index right now is at a 5-year high. We have seen a consistently stronger dollar, not just today, Guy, but really throughout the duration of 2022 thus far. Every single G10 currency weaker against the U.S. dollar on the year. And of course, it comes back to the conversation about rate differentials and the divergence in monetary policy. Of course, your big underperformer on the year is the Japanese yen, because the BOJ is going nowhere on the tightening front. At the same time, you have a Federal Reserve that is trying very hard to get inflation under control and plans to be aggressive to do so. Europe, though, and the ECB in particular, how do they do that on the inflation side amid the growth concerns? And I think you're seeing that reflected in those currencies, both the euro and the pound, Guy.
It's interesting that the currency market is where the heavy lifting is happening here. In terms of the setup, the understanding is that there's quite a big air pocket kind of under 103 around euro dollar. There's the other factor as well in all of this, which is what is happening with the Chinese currency, the yuan, which has been weakening significantly. And I think that's playing again into this narrative around euro dollar. The gas story front and center. We're going to look for some answers on exactly what the rules are regarding paying for Russian gas. Can you pay in dollars? Can you pay in euros? If you pay in rubles, what happens? Thierry Breton is going to be joining us next. This is Bloomberg. A little confusion this afternoon regarding the rules for how you pay for Russian gas. We certainly had a significant warning a little bit earlier on from the European Commission, it coming from Ursula von der Leyen, the President of the European Commission, basically indicating that if you pay in rubles, you are breaking sanctions. This follows, of course, the cutting off of Poland and Bulgaria from Russian gas. Let's listen to what Ursula von der Leyen had to say.
Our guidance here is very clear. To pay in rubles, if this is not foreseen in the contract, to pay in rubles is a breach of our sanctions. We have round about 97% of all contracts that explicitly stipulate payments in euros or dollars. Companies with such contracts should not accede to the Russian demands. This would be a breach of the sanctions, so a high risk for the companies.
when are the terms of the contract satisfied? Is it when you pay the amount in euros, or is it ultimately when those euros are transferred into rubles, and at that point is the contract satisfied? This is going to be critical. The lawyers are going to spend a lot of time arguing over this. Some guidance, some clarity would be really, really useful. Joining us now, Thierry Breton, EU Internal Markets Commissioner, joined in Brussels by Bloomberg's Maria Tadeo. Maria.
Yes, Guy, well, there's a lot of confusion here, but what is clear is that Russia, of course, is trying to prop up their currency and, of course, sidestep the sanctions on the central bank. I mean, that is clear. They're using Gazprom as a central bank, essentially. But we're joined now, of course, always happy to say, by the Commissioner for the Internal Market, Thierry Breton. Of course, for an international audience and our American watchers that are watching this, you're in charge of this huge market that is the European Union. But I have to ask you, today there's a lot of confusion about this Russia situation. What's going on?
Well, what's going on? We were, to tell you the truth, it's not really a surprise. And we were prepared for that.
Oh, so you were expecting that this could happen?
I mean, we are preparing ourselves to any circumstances, and we better be, because with the war in Ukraine and with the way Vladimir Putin is behaving, yes, we have to be prepared. We were prepared. So I think Ursula von der Leyen was very clear. She said it very clearly. 97% of our contract made that it should be paid in dollars or in euros. And if you don't do it, that's a breach. And of course, you could be exposed to sanctions. So I think everyone will be very careful now.
But Mr. Breton, we know that a number of countries said we're open to paying in rubles. We understand that a number of companies, European companies, are setting up twin accounts. I mean, when they say we pay in euros, Russia does a conversion, that's okay. I mean, I know this is very technical, but is there a real risk that these companies are actually getting this wrong, could be sanctioned?
I think President von der Leyen was very clear. That's very clear. Yes, I think there's a risk. Yes.
And how do you see this war in Ukraine with Vladimir Putin really stepping up this ahead of Victory Day? I mean, are we going to see the worst of the war now?
I think obviously we have to be prepared, and we have to be prepared. And unfortunately, yes, it's definitely not over. So we are preparing ourselves for a long situation, and not a rosy one.
And of course you're French, your country, your home country, not that you speak for the French, but of course you know the sensitivities there. The French government has said they're now in favor of this oil embargo and potentially look into gas. Do you believe this is going to happen ultimately quicker than we expect?
Well, I know that this will be under discussion. It has been under discussion already for the past few weeks. So you know that we are working now for a new set of sanctions, the sixth one, and I could tell you that yes, every options is open, including the one to put fuel.
And how's the relationship with Germany?
Well, I think everyone now will receive for the next set of sanctions. For fuel, I really think that there is now an alignment between us, but we'll see.
Commissioner, can I just take you back to the preparations that have been made for the potential cutting off of Russian gas to the European Union? The Commission President, Ursula von der Leyen, said that the Commission had been working on this since March and that there was a significant reduction in the dependency that Europe has. March seems like a very, very late date to be preparing for this possibility. She talked about the fact that it was important to work with reliable partners. Hasn't it been clear within the European Commission for a very, very long time that Russia is not a reliable partner?
So, of course, that's two questions. The first one, of course, that's a decision, and mainly for the one we were depending a lot from Russian gas, and we know all the story with, especially with Germany and others, with the decision, of course, also to exit nuclear energy, and it has been a decision then taken with Nord Stream 1 and Nord Stream 2, and you know the story. But that's, of course, the past. Now, I could tell you here that since day one of this war, we worked immediately, and when I say we, especially with my team and in my directorate, we worked on the eventuality of what we will do if we have to get rid of the 155 BCM imported gas in Europe, shutting down overnight. So we have plans, we work on this, we are ready, and of course it's not in our hands, of course, but we worked to be ready if this happened. And by the way, this is what happened now in two countries, but I could tell you that because we are a continent, we will work in solidarity, helping, of course, those countries who will need us and our support, and I'm speaking mainly, of course, today of these two countries, to help them to transition as quickly as possible to avoid any bad impact.
Commissioner, okay, so I'm going to ask you two more questions here. You talk about being ready. What does that actually mean? How ready are you at the European Commission for this to happen? And are there going to be any issues with Germany taking gas in and then providing it to other members of the European Union? Are there going to be any issues there? Will that trigger, do you think, further problems for Germany being able to buy gas from Russia?
I mean, again, we are, as you know, gas is not on the sanction list, as you know, so we are not in this situation now. But of course, if there is a shutdown from one country or the other, we are ready to support the country which will be affected. The answer is yes, we have the plan to do this.
And Commissioner, of course, that is the topic of the day, but the topic that you've been paying attention very closely is that takeover from Elon Musk on Twitter. Twitter has become a big battleground, by the way, of misinformation from Russia. You've said it openly. Do you worry about the turn that we're seeing perhaps in social media? A lot of power concentrated on very few individuals?
Well, you know, there's two things. The first one is, of course, the shareholding. And the shareholding is the shareholding. But when you're a shareholder, you have a company, you have a board of directors, and you have obligations. So for me, as a regulator, I'm not concerned by the shareholders, I'm concerned by the governance structure of the company and how they behave.
Are you going to have a problem with Elon Musk?
No.
Is that what you mean?
I will not have any problem with anyone, and you know why? Because I think it's extremely important that everyone understand that we worked for the past 2 years, days and night, finally, to have what was expected, including in the US, but we did it in Europe. We organize, we regulate now our digital space. In other words, we say that everyone is welcome, but for the big platforms, we have rules. Freedom of speech, no hate speeches, no harassment, no pedopornography, controlling any terrorism act or whatever, no sale of counterfeit product. This is now how we organize. It has been decided, it has been voted now, it is our rules, and you know, the things will be extremely clear for everyone, including Elon Musk. Of course, you're welcome to come in Europe, we welcome everyone, but you know what? We have rules, these are our rules, and you will need to follow these rules if you want to benefit the European market, which is, by the way, 1.5 bigger than the US market.
But very briefly, how do you combine all of this with a CEO like Elon Musk who says, for me, I say freedom of speech above everything else? How are you going to combine all of that with someone who says freedom of speech comes first?
I'm just saying, I don't care of what he's doing outside of Europe. You want to enter into Europe? These are our rules. If you don't follow it, we have a fine up to 6% of the global worldwide revenue. And if you continue, unfortunately, we have a ban. What? And we will have to do it for everyone, not only for him. That's our rules to protect our freedom of speech, our democracy, and our rule of law.
Well, I look forward to that meeting with the first one-on-one that you'll have with Elon Musk here in Brussels. I'm sure it will be entertaining, to say the least.
Maybe sooner than you think.
Oh, well, do you have a date?
We'll see.
Okay.
Thank you.
Well, Thierry Breton, thank you so much for joining us. Of course, Commissioner for the Internal Market joining us today on a very busy day. He can talk everything. Guy, back to you.
Sounds like it could happen soon. Maria, great interview. Thank you very much indeed. Thierry Breton, the Internal Markets Commissioner, and Maria Tadeo joining us from Brussels. While we've been speaking, European stocks have started the process of closing down for the day. Largely, actually, a session that has been spent in negative territory, but actually things have started to improve, as you can see. The FTSE 100 now up by 0.7%. The CAC 40 up by 0.2%. The DAX is flat. Some of the eastern countries a little bit more negative. But the story, I think, has been elsewhere. So let's just take a quick look at the shape of the session.